talk on Futuregrowth's flexible income composite fund and investment strategies. We're joined from our Cape Town studios, as I said, by Wikus Furstenberg, portfolio manager from Futuregrowth Asset Management. Wikus, thanks very much for joining us. In terms of the fixed income environment right now, what are you seeing?
Well, Bronwyn, what we are seeing obviously is volatility, especially the last few weeks. But what's interesting to us really that stands out at the moment, and there are good reasons for that, is the fact that the slope of the local bond yield curve is particularly steep. And, you know, from our point of view, it looks very, very interesting. What's also interesting is the fact that, you know, after a very good performance last year, the inflation-linked bond market seems to be losing momentum.
Because obviously in your fund, one of the key things to be aware of is the relatively low yield you're getting from cash, certainly relative to inflation. So I would imagine that a lot of investors are looking at it and hoping that your fund will perpetually beat inflation. If you look at the components, where exactly are you on the yield curve in order to do that without exposing the client to too much risk?
Kevin, clearly, you know, if you want yield, and you know that, you have to be able to take on a bit of risk. But clearly, given the mandate of this particular fund, the credit exposure that we have, where we get most of the yield pickup, sits in the 3 to 5 year area of the yield curve. The very, very short end of the curve, 2 years or so, is very, very expensive. So we're not holding any sort of government bonds in that particular area, but our credit sits around about 3 to 5 years out. We don't really go out that far or further than the 5 years in terms of credit at the moment. But, you know, having said or mentioned the steepness of the yield curve, it really points to longer dated fixed rate bonds, but as you mentioned, that comes with some volatility. But in this environment, you know, at some point, especially if there's panic in the market, it probably makes sense to start looking at some yield.
Earlier, Michael Keenan is saying that they are expecting interest rates to tick higher, that is Absa Capital, before the end of this year. Do you agree with that view?
Yeah. Bronwyn, no, we disagree with that. I think, you know, given what's happening globally in terms of positive but below trend growth, we know recession in the Eurozone area, even locally, although we're sort of hovering around, you know, anywhere between 2.5–3% in terms of growth, you know, we're well below where we think potential is. And if we do expect inflation to start rolling down to levels close to 5.5% year-on-year, that's headline. And yes, I sort of accept that core in CPI is probably going to go to higher levels than where it is at the moment. We don't expect the central bank to react by normalizing interest rates that early. In fact, we're probably closer to somewhere mid-year next year, more or less.
Because earlier on you were talking about inflation-linked bonds, suggesting that they're not as attractive as perhaps they were. You know, given where your inflation outlook is at the moment, do you hold any inflation-linked bonds in the portfolio?
Kevin, yes, we still hold inflation-linked bonds in the portfolio. The holding is down to 9% though. It was as high as 15–16% at its peak earlier this year. So what we thought of doing was to slowly reduce our CPI-linked bond exposure into strength. Still hold a bit at the moment because although it did very well, you know, we still have some inflation to deal with, even though it might be lower than where the peak is at the moment. And of course, we need to also look at expected returns relative to cash. If we sort of believe that cash rates are going to stay unchanged for 12–18 months, then CPI linkers, although not as attractive as last year, it still looks slightly better than cash. But I think the big trade in our minds is how CPI linkers compares to medium to slightly longer dated fixed rate bonds.
Because a moment ago,
there, I think the opportunity arises for us to use some of those proceeds to actually sort of start nibbling at these longer dated fixed rate government bonds at the higher levels, you know, into weakness like the market is doing at the moment.
In terms of the international environment, a moment ago you referred to panic in the system. Do you think that the panic is here to stay?
Bronwyn, that's very hard to tell. I mean, we sort of prepared ourselves for market volatility. We experienced that, since 2008 for that matter. So 2012 is not going to be any different. I think the fact that the market is giving back the gains it made since the Citigroup announcement of the World Bond Index, I think we sort of welcome that. The market certainly overreacted a little bit in April. We're giving back, and I think we're sort of seeing yields getting back to levels where it probably makes more sense on a medium-term view.
Because can I just ask you a little bit broader than your portfolio, and that is about government finances generally. The government's trying to obviously move towards fiscal discipline, it's trying to get its budget deficit down. It's going to be quite a hard task from my perspective. Are you concerned about the state of government finances generally?
Kevin, yes, we are. As we all know, 2011, 2012 turned out to be a little bit better than we initially anticipated, October as well as in February of this year. But we're a bit concerned about, the next 3 years or so. And there are a number of reasons for that. And that's why one's got to be careful what you buy, at what sort of levels you buy. So if I say we're happy to buy medium longer dated fixed rate bonds, obviously we want to buy that into weakness. I mean, a 2031 fixed rate bond trading at 9% plus looks certainly more attractive than trading at the levels where it traded like 2 or 3 weeks ago. And one reason for that is not so much inflation, but certainly one eye on government's performance in terms of reaching those budget deficit targets over the next 3 years. And one thing that comes to mind, and I think we talked about this before as well, is current as opposed to capital expenditure, what's happening in terms of that change, that ratio, and of course also what's happening to wages. I mean, the wage bill, we all know it's growing, and we are concerned about that. We are concerned about the power of the labour unions within public sector.
While we're outside the ambit of your portfolio, Andrew Cantor from the Futuregrowth stable often says on this show that he wouldn't touch US government bonds with a barge pole. Is that still the status quo?
Bronwyn, yeah, I mean, nothing really has changed in terms of that. But as we all know, I mean, what's happening at the moment, as soon as the risk-off trade shows face, then there's this flood into US Treasuries, and of course supporting the US dollar as well. So it's very hard to fight that trend, but yes, I mean, with the 10-year trading at 1.8%, it's very hard to convince yourself to sort of go boots and all into that market at these levels for whatever reason.
Because can you just give listeners some perspective on the types of return this type of portfolio would give you relative to cash? Obviously, a lot of investors we find are still hugging cash, still seeing that as the sort of safe option given all the global volatility, given the problems in Europe. Yet that return is below inflation. A portfolio like yourself, which still has quite a big element of cash in it, probably around about 20-25% cash, what sort of return does that portfolio generate relative to cash?
Kevin, if we sort of maybe could start off with a typical core money market portfolio on our side, given our view, we would expect, for that to give us like maybe 6% over the next 12 months. And given our view on where we think the longer dated fixed rate bonds might sort of, what sort of returns they might sort of render, credit spread that's included in the portfolio, and hopefully getting it right in terms of that allocation between fixed rate CPI linkers and also variable rate bonds, we're hoping to get a return closer to about 9%. So, you could maybe expect like a 3% better return in this particular type fund versus a money market fund. If all goes well, it could be a little bit better than that, but I think we need to take into account markets are volatile. And having said given you the view on credit, I think it's also important to note that credit spreads have narrowed or tightened a lot the last 12 months. And it's very hard to go into that market and actually replace the spread that we managed to buy post-2008.
I know, Wikus, that forecasting the rand is pretty much a fruitless activity, but we have had two forecasts on the desk this evening. Michael Keenan thinking that 860 is on the cards in terms of dollar rand, and Stan Lib with Kevin at around 820 by year end. I see that maybe coming quicker than you think, as you indicated.
It's not a straight line.
As you indicated. Where do you stand on the rand, or don't you even bother to forecast on this one?
Yeah, well, I'm afraid you have to have a view on the currency. We prefer to look at the trade-weighted value of the currency as opposed to just, taking very strong views on individual sort of exchange rates. But, I mean, at the end of the day, to get to that basket, you have to sort of have a view on for instance, dollar rand. And we're probably closer to where Kevin is. We would be really, really careful to sort of try and, just extrapolate the current trend. I wouldn't be surprised to see the rand even slightly stronger by year end. I mean, what we said at the beginning, and that's what we've seen last year as well, is we're going to see significant volatility in markets for obvious reasons. So I think what we're seeing at the moment is part of that.
Wikus, can I just ask you one final question? If you look at your portfolio, you look at the structure of the portfolio, what is the thing that concerns you the most? What is the thing that troubles you the most in terms of how you're positioned at the moment? In other words, what is the biggest risk that you're looking at that you're thinking, if that starts to happen, maybe the portfolio comes under pressure? What troubles you the most?
It's, Kevin, it's certainly the exposure to medium-dated fixed-rate bonds. If the current market volatility continues, clearly you're going to see a negative mark-to-market impact on the portfolio, which is something you don't want to continue for too long.